Morning, ladies and gentlemen. This is Greg McCloskey from the FXDD, and this is the Friday, March 19, 2010 New York opening Forex report. I remind everybody that trading foreign exchange is risky and should only be done with risk capital that will not change your lifestyle. Traders could lose all their risk capital trading Forex. FXC does not guarantee any recommendations made within its commentary. Traders should make market assessments and take trades positions based on their own personal market analysis, risk tolerance, or financial condition. In addition, care should be made to only use leverage which is congruent with your personal risk tolerance. Although care was taken in creating this report, FXC does not guarantee the accuracy of the information. Well, today we got off to a continuation of some of the trends that we saw yesterday. The euro continued its move down. The sterling continued its move down. The dollar yen had a fairly quiet day, and the Swiss franc, especially the euro Swiss, continued its probe to the downside after yesterday's comments from the Swiss National Bank official saying that the businesses and consumers should get used to higher borrowing costs and a more free-flowing or market-derived Swiss franc rate. So that sent the euro Swiss down to very sharply. So let's go in, take a look at some of our currency pairs as we enter today's trading day. And we'll start off with the euro. I mentioned that the market has been moving down, and the 50% retracement of the move up from this low back in let's call it the March low to the March high. That's the month that we are in. But the 50% retracement came in at this level, 136.27, and the market moved up toward that level and found it has a nice ceiling, and then started to sell the market off at that time, and you can currently see that the market is now below the 61.8% retracement at 135.82. That was a level that we held yesterday, and it's pushing lower toward the 135.51 level. I have a horizontal line at that point, and you can see if you go back in time, we had these lows here. This was at 51. This low came in at 135.28. This low came in at 50. We had another low there at 51. We broke through it there briefly down to 37, and then started to use it as a springboard to the upside. Again, had lows at 53, low at just a little bit lower than 53 there, maybe like a 48, and so that area is going to be a level of support here for the euro versus the US dollar, and we are seeing it happen. We did reach a low here with early buyers at the 59 level, so we've been watching the 51 level as our key level to the downside. Put a horizontal line in your chart at that level. Let's take a look at the 5-minute chart and see what that is telling us. And if you go back and take a look at these parallel lines here that I drew in here, connecting the bottoms and the tops, you can see that we do have a couple little bottoms there, and then we have this trend line coming in just around that 51 level as well. So that's going to be another reason why the 51 level would be a level of importance. On the top side, we do have the 100-bar moving average and the 200-bar moving average at the 136.07 level. You can see at this point right here, we had the market where the two moving averages and the price converge. That's what we call threes company. When usually that happens, you see the market move in a direction either to the downside or to the upside. And in this case, the market decided that, okay, well, we got this topside resistance here. We tried to move to new highs, but we ran into this ceiling here. At this level right here. I didn't mean to put an arrow, I meant to put a straight line, but that ceiling kept the market under wraps, and then the market started to fall to the downside. In the pound sterling, there was some concern again from government officials or Bank of England officials that the UK would return into a potential for a double dip recession, despite the stronger data that we saw this week in the employment situation, and that hurt the pound sterling here today. I'll put this on the hourly chart. You can see how the market sold off of that. In the process, we went back through the 100-hour moving average. That 100-hour moving average comes in at 151.99, and we went down toward the 200-hour moving average, which we normally do. The 100 is a trigger point. The 200 is a confirming. We are what we call in between our goalposts here. That is defined by the 100-hour moving average. Again, that's the blue line here, and the 200-hour moving average. So with the price in between those two levels, now trading at 151.50, we could see the market bounce back and forth in between those two ends or bookends. If the market, though, however, breaks through to the downside, let's say breaks through the 200 bar moving average that comes in currently at 151.15. We could see further deterioration in the pound sterling to lower levels. And then what levels can we look for? Let's put a Fibonacci retracement level up there, connecting the March lows to the, is that the March lows? No, it's not the March lows. It's March 9th lows to the high here, and we are at 50% retracement at 151.26. Another reason why there should be support at that level, and that's what we saw. We break through that level, and then we're heading toward the 150.65. That would be their next target level. So watch these levels right here. Watch this 100 bar moving average, and watch this level up here as resistance. That's what the hourly bar charts are telling us at 151.50. Not sure what to do. Let's take a look at the 5-minute chart. Maybe it'll tell us a little bit more. And if you look at the 5-minute chart, we drew a line there that went through that line yesterday. But the market is down here consolidating at the lows. Let's move a Fibonacci from the high to the low here. And we can see the 38.2% one comes in at 151.84. Not giving really much clues as far as the market goes. You can put in some trend lines here and perhaps use those as our upside support and resistance level. But you can see, the market is consolidating here at the in this area right here, and the market, so it's a question of getting above these highs to move up toward the top end of the hourly bar, or moving through this triple bottom here at the low at 151.27. That's the game plan. Let's take a look at the euro source. I mentioned that continues its move to the downside here, and the market sold off here off the comments, then corrected up here, and in the Tokyo session we just had a very quiet calm before the storm, and then the market took off to the downside again when the European entered the market. We did go down to 143.17, and I'm going to go to the weekly chart here, and you can see how the market has support at this 143.00 level that goes all the way back. This is a weekly chart going back to 2008. This is October 2008. The low reached 142.99, and the low here today reached 143.17. So I'm not surprised that we see some buyers against the low. There's nothing much really going back all the way. You go back a long way before you see that line again. So this is quite an important level, and if the market should break through that level, we should see further strong selling in the euro versus the U.S. The Swiss. Let's head on to the dollar yen. I mentioned that had a very quiet day, and you can see the 100 and 200 hour moving average are converging at 90.38. We talked about that just a little while ago, saying that when the two moving averages end, the price converge at the same price. We tend to get either a move to the upside or a move to the downside. And looking also at the this currency pair, it's been in this very narrow range here as defined. I can put a big yellow line there. More or less by this range, lots of activity in between 90.13 and 90.72. That's not a big range for the dollar yen. So next week, or perhaps next week, we could see a move either to the upside or downside. Use this 100 and 200 hour moving average as your pivot point. If we're above it, it's bullish. If we're below it, it's bearish. Let's go to the dollar Canada. They just had data come out. The CPI came out better than expectations at 7 o'clock. And this brings back into focus the strength of the Canadian currency and the Canadian economy. We keep on getting better data out of Canada. Now we're seeing a little bit better inflation as well, and that's caused the dollar Canada to gap. Look at this gap here that we left here in the dollar Canada chart. Gap lower here off the hourly chart. The market just took a nosedive here. Normally those gaps get filled at some point or another, but we saw in the euro dollar when it gapped over the weekend a few weeks ago. It took about 3 weeks to come and fill that gap. So don't just be so quick to pull the trigger to say we're going to go fill a gap. We may today, who knows? But we do have a lot of support down here in the dollar versus Canada, but we are back below the 100-hour moving average. That 100-hour moving average currently comes in at the 101.46, and the 200-hour moving average, which we didn't get up to, came in at 101.94. The market has not been able to get above the 200-hour moving average in quite some time here, going all the way back to March 1st. So the whole month, the market has been below the 200-hour moving average. The trend has been to the downside in the dollar Canada as better data and higher oil prices propel that currency to the upside. We do have support at the the 109 par 90 level, and then down here at the trend line, which is also near the lows for the week at par 69. That's my morning report. We'll talk to you later. Bye bye.